Ladies and gentlemen, or good afternoon. It is my sincere pleasure to welcome you to today's webinar on employee mobility in times of COVID-19. As you all know, the ongoing pandemic causes disruption to businesses worldwide. And even with furlough and lockdown sessions being slowly eased throughout the countries, COVID-19 will continue to challenge society and businesses alike. Today, we will particularly focus on cross-border tax issues arising from travel restrictions and substantial changes to regular work patterns. Our expert speaker in this field will be Priya Selvanathan. She is our head of tax and transfer pricing for the ASEAN Pacific region, and she falls back on more than 10 years of experience in corporate tax advisory, transfer pricing, and value chain transformation in Malaysia, Singapore, and Myanmar. During the session, you will have the opportunity to submit your individual questions via the chat option of the webinar tool. Please feel free to use it. And please note that we will record this session and make it available online later on for you and your colleagues to recap anytime you wish. It is now my pleasure to leave the stage to Priya, and we're all looking forward to a most enlightening session. Thank you very much.
Thank you, Bettina. Right, yes, so as Bettina mentioned, so first of all, good morning or good afternoon, whichever part of the world you are in right now. So as Bettina mentioned, yes, so of course in these times of the pandemic, it's grounded most of us. Travel restrictions, lockdowns have been put in place by many governments to prevent the spread of the virus. So with that, there's been a lot of upheaval for businesses in the sense that, you know, there are travel restrictions, so you can't travel, and as we are in a more globalized business environment now, where travel is a normal part of business, so you may have a regional role or even a global role that requires you to travel frequently. And with these travel restrictions in place, there could be some quite serious tax implications that that could possibly you know, affect your businesses. That, you know, so we will be running through some of these issues that you may have thought about or you may not have even thought would be an issue. So we'll be running through some of these issues and how you could possibly mitigate some of them. So to start with, I'll just run through with you first the agenda for today. So to start with, we'll run through very briefly an overview of the COVID-19 situation in the region. So what's happening around the region, and then how would the COVID-19 travel restrictions impact your employee mobility? Later on, we'll go into a little bit more detail and discuss tax residency for both individuals and also companies. And then thereafter, we will cover some taxation of cross-border business activities. So we will look into permanent establishments and corporate tax issues. And then finally, to wrap up, what you could possibly think about as we step out of this this pandemic and this crisis, because as we know that this is not going to last forever. So what would you do in the longer term? There are certain things that you can put in place in your business. So in case things happen, you know, in case of another crisis, you will be possibly more prepared. So let's get right into it. So what has been happening around the world? So as you can see on this table here, I've sort of summarized in the region what has been going on. So there have been various lockdown measures and travel restrictions placed by governments in many countries. So I focus here on this table mainly in some of the countries in the Southeast Asian region, and also included China and Australia and also Germany. So as we can see here that there have been many travel restrictions placed by the governments. So mainly restricting travel into a particular country. So if you're a foreigner, you typically cannot enter a country unless in some certain cases, if you have a valid work permit, then you can enter. But in typical cases where even if you can enter, you are required to enter into a 14-day quarantine period. So while we are going through this, and this has been in place for almost 2 months now, certain countries have started relaxing some of these lockdown measures. In Malaysia, for example, a few weeks ago, most businesses can now reopen, subject to certain conditions. So there are certain SOPs in place, and this we see is also applicable in other countries like Thailand and Vietnam. So social distancing measures are still in place, while local businesses can now generally reopen. The borders are still closed. So what this means is that there is not going to be a lot of international travel for a while, and likely there is not going to be international travel, and borders are not going to be open for quite a few months now. There is talk, however, of creating some travel bubbles. For example, New Zealand and Australia have been talking about creating a safe travel bubble between Australia and New Zealand. Possibly also within the ASEAN countries, there's some talk of creating a travel bubble within the region. So while these talks are going on at the government level, I personally don't think that this will happen anytime soon. Probably it will be at the very best a few months before we see this happening. So while this is happening, I mean, of course, your business still has to go on. So how would these travel restrictions impact your business? So these strict travel restrictions and quarantine requirements imposed by governments definitely has an impact on the business. So what does this mean effectively? So what would this mean to your business? So you may have some employees that are stranded outside their country of residence, or you may have employees working remotely from a third country. You may even have some employees that have returned to their home country and are now unable to return to their country of employment. So in such situations, there could definitely be tax impact, and possibly not even just tax impact. There could also be some immigration issues as well. So what about visa and work permits? What if your employee's visa expires while they are in the country? Or what if it expires while they are outside of the country and this cannot be renewed due to the lockdown measures? So, and then what about tax residence of individuals, and not just individuals, but what about the tax residence of companies? And even in addition to that, also, if you have employees working remotely, there could certainly be permanent establishment issues. And I'll be running through some of these issues in a bit more detail later on. So on this slide, you will see some of the potential tax issues that you could possibly face due to the employee mobility issues. So the first thing would be, would there be a change in the residence status of individuals due to the lockdown measures? So for example, if you have an employee working in a country which is not their usual place of work, or in their home country, but where they are no longer tax residents. So for example, if you're a German national, but you've left the country for many years and you're now working in Singapore, for example, for many years, and you are no longer a tax resident in Germany, but you have returned now to Germany, to ride out the storm, and you are working remotely out of Germany, would this now make you a tax resident in Germany again? Would you still be a tax resident in Singapore in such a case? So these are all questions that we need to ask ourselves. So will this change your tax residency status, or will it add on? So could it possibly a dual tax residency? And if there is a dual tax residency, is there a double tax agreement in place where you can apply some tiebreaker rules? Sorry. If there is no double tax agreement, can you get any relief under the domestic tax law? So certainly a lot of questions to be asked. We may have some answers here, certain things we may not have all the answers to. And what about the taxability of employment income? Could you be seen as deriving the employment income in another country that is not the country of your employment? So even if you are not a tax resident, will you then be subject to tax in that country as well? So if you are taxable and you're a tax resident in the country, what could be the tax implications? In addition to that, would there also be obligations for the employer. Is the employer required to register as a registered employer? Are they supposed to do any monthly tax payments to the tax authorities? So this depends on the country as well. So these are certain questions that you would need to ask yourselves. What about tax residency of a company? If directors are not able to travel, does the country allow for virtual board of directors meetings to be held? Or would you at least have to have a physical quorum locally with the other directors dialing in? What about the flip side to that? What if you have a director that dials in for a board of directors meeting from a country where the company is not normally a resident? Would this then make the company a tax resident in the other country? Because there's now central management and control in that country. So there are certain countries, for example, the UK, that apply this test of central management and control. So such things could create a risk where you may actually create a tax residency in another country where you typically don't have your usual business. And then what about permanent establishment issues? If you have an employee stranded somewhere and is working remotely in this third country, could you be seen as creating a permanent establishment? What is his function in the entity? Does he carry on a business? Would he be seen as a dependent agent? Again, in such cases, we can also look into a double tax agreement if there is one. Will the double tax agreement provide any relief? But if there is a permanent establishment, there may still be some local tax filing requirements. And will you be able to claim a foreign tax credit in the foreign country? So these are some of the issues that you should be thinking about if you have employees that are stranded somewhere or employees working remotely in another country. So to make this a little bit more clearer, so let's run through a few examples. I have some scenarios set out here. So the first scenario is an extension of a short-term assignment due to a travel restriction. So in this case, the background facts are as follows. So you have an employee from a German company who travels to Malaysia for a short-term project that was to be from January to May 2020. He was actually initially expected to leave by the end of May. But due to the lockdown period in Malaysia from 18th March, he's now unable to leave Malaysia. And so he decided to just stay on in Malaysia and continue working remotely from Malaysia until the lockdown and the travel ban is lifted. And he also decided to stay in Malaysia because he does have to continue working at the client site until the completion of the assignment. So he will likely only return to Germany at a later time, as he needs to finish his work at the client's premises. So what would be some of the issues that could possibly arise here? The tax residency status. So will his tax residency change? So he is a tax resident in Germany, but now, due to the extension of his stay in Malaysia, he could very well become tax resident of Malaysia as well. If it was within the initial period of the project, which is from January to May, he would most likely not be tax resident in Malaysia. But if it's extended until possibly July or August, he may very well be tax resident in Malaysia. And in this case, he is still tax resident of Germany. So would he then have a dual tax residency? What about the taxability of his employment income in Malaysia? Will this be deemed to be derived in Malaysia and subject to tax in Malaysia? Going back to dual tax residency, will he be paying tax on the same income twice? This could certainly be the case. Again, we go back to the double tax agreement. So Malaysia and Germany does have a double tax agreement, which does provide tiebreaker rules. So if he is seen as having his habitual place of abode in Germany, then Germany may have the taxing right. So Germany will be his tax residence, and Germany may have the taxing right. Of course, these need to be looked into more detail depending on each specific case. Another key issue that we we'll go back to frequently today in a few of the other examples as well, is the permanent establishment. So will there be a permanent establishment of the Germany company in Malaysia? This again depends on the type of activity that he is carrying out in Malaysia. So what is the scope of his work if it's short-term assignment in Malaysia? If it is some sort of installation project, if it goes beyond 6 months, they very well could trigger a PE in Malaysia, and the German company may have to register a PE in Malaysia and pay taxes in Malaysia. So going to the next example here. In the next example, we have an employee that is stranded overseas. So in this case, we have a Singaporean national. He was hired by a Malaysian company, and his employment was initially supposed to start on the 1st of April. But because of the travel restrictions, he's now not able to travel to Malaysia, but he starts work anyway. And he starts work anyway, and he works from home in Singapore. And prior to the travel restrictions and prior to his start date, his work permit, his Malaysian work permit has all been approved. So what could be the potential issues here? He's already employed by the Malaysian company, he's already starting work, but he's working remotely from Singapore. Would the income for his duties performed in Singapore be deemed to be derived in Malaysia? This very well could be the case. And anyway, he is carrying out his duties for a Malaysian entity. It would be generally deemed to be derived in Malaysia. The other question we could be asking ourselves is, would he still need to pay tax in Singapore on this income? Again, will there be a dual taxation? Will he be taxed on the same income twice? And in this case, we can again go back to the double tax agreement to see if there's any relief provided. And then similarly, again, another question we need to ask ourselves, what about a permanent establishment? Will there be a permanent establishment of the Malaysian company in Singapore arising from his work carried out remotely in Singapore? If he's carrying out a sales function, and if he's negotiating and concluding contracts for the Malaysian company in Singapore, this could very well trigger a PE. And we'll get into some of the more details about, there is some guidance actually issued by the Singapore tax authorities and also the OECD on how to deal with some of these issues. Let's look at one final example here. So in this case, you have a social visit turned work from home arrangement. So in this case, we have an employee of a German company. He works in Germany. He is a German tax resident. Makes a social visit to Singapore sometime in March to visit some friends. And he was initially expected to leave in April. And due to the travel ban in Singapore, he's now unable to leave Singapore. So he decides he's quite comfortable in Singapore, and he says, you know what, I think I'm going to stay with my friends until the travel ban is lifted. While he's in Singapore, he decides, okay, I'm just going to work remotely from Singapore. What are the potential issues here? Again, the tax resident status, because he's a German tax resident and now he's working in Singapore. And initially he was just expected to be in Singapore for a short period of time. He was not working. Now he is working in Singapore and he does not have an expected date where he's leaving. What if this extends beyond the 6-month period where he would now be regarded as, he could potentially be regarded as a Singapore tax resident? So as discussed in the earlier example, there is also a risk of dual taxes. So if he's Singapore tax resident, if he's seen to be carrying out his employment income in Singapore, he could be deemed to be derived in Singapore. But at the same time, he is also employed by a German company, he's German tax resident, he would have to pay taxes in Germany. So in this case, would there be a double taxation as well? Again, we can go back to the tiebreaker rules and the double tax agreement to see if there's any relief provided here. And again, what about a permanent establishment? Could he create a PE of the German company in Singapore? Possibly, yes. Again, it depends on his function. Does he carry out a sales function? Is he carrying out a short-term assignment here? That what if he is staying in Singapore and then at the same time the German company possibly gets an assignment in Singapore and they say, okay, you will now work on this project in Singapore. Could there be a permanent establishment here? As I mentioned just briefly ago, the OECD has issued some guidelines and guidance on dealing with these tax issues. Some countries have also issued their own guidelines. Malaysia has issued their guidelines. Singapore, Australia, and the UK have also issued their own guidelines on these issues to deal with these issues as well. So let's deep dive a little bit further into what some of these issues mean and how you could possibly mitigate some of this risk. So first, let's look at the individual tax residency. So as we discussed in the previous examples, the extended stay in a country which you are normally not tax resident could now make you a tax resident. So deriving income while you are in these countries could make you subject to tax in these countries. And as you can see from the table here, most countries within the ASEAN region, within the Southeast Asian region, determine tax residency based on the number of days of your stay, so the period of your stay. So if it's typically between a period of 182, 180, 183 days, then you will be regarded as tax resident. There, of course, may be certain conditions in each of the individual countries, but this is the general rule, with the exception of Thailand. Sorry, yeah, so it is typically 180, 182, or 183 days. But in Germany, for example, the tax residence of an individual is determined based on their residence that's available to them or their place of habitual abode. So what could this possibly mean? This could create issues with dual tax residency. Because if you have your principal place of residence in Germany, for example, and at the same time you are staying in Malaysia, for example, for a period of longer than 6 months because you can't leave, you came here for a project and then now you can't leave and it's extended beyond 6 months, you will be tax resident in both places. So in such a case, what could you do? Again, like I said earlier, you could possibly look into the double tax agreement to see if it provides you with any relief. But having said that, claiming double tax relief is not so straightforward. Certain tax authorities in certain countries require a lot of documentation to be produced before you can actually claim these reliefs. Some countries are also not very, the authorities in some countries are also not very, may not be so sophisticated. For example, in Vietnam, in Thailand, they may not be so sophisticated as to allow these double tax reliefs. So it's generally quite difficult in these countries. However, so having said that, the OECD has issued some guidance on dealing with these issues for determining the resident status of an individual. So as you can see here in the first scenario, we have a person that is temporarily away from home and gets stranded in a host country. Or if you have a person that is working in a country which is their current home country and has acquired resident status there, but temporarily returns to a previous home country because of the COVID-19 situation. In this case, the OECD says it is unlikely that this would make the individual acquire resident status in the country where they are temporarily present because of extraordinary circumstances. So this is unlikely. So such cases like this, where you have an employee that is stranded somewhere, or if you've had an employee that has had to return to his home country where he is no longer tax resident, this would not likely make him acquire tax resident status in that country because these are extraordinary circumstances. So such circumstances do not arise in the normal course of business. It is because of this COVID-19 situation. So it's unlikely to change your tax resident status. Having said that, however, not all countries may follow this guidance because, as I said, this is just guidance by the OECD. It is not binding law on the countries. In addition to that, many countries in the region are also not OECD member states. So it is not likely that they may follow this. So there is also not much guidance yet. Having said that, however, Malaysia and Singapore have issued guidance on this, and they typically follow the directive and the direction provided by the OECD. So in Malaysia, the guidance says that individuals who are temporarily absent from Malaysia, so if you're a tax resident in Malaysia, and now you are temporarily absent, this should not change your resident status. Non-residents who are temporarily present and they're not able to leave because of travel restrictions should also not be regarded as a tax resident. In Singapore, for example, if you are a Singaporean that is or a Singaporean permanent resident that is working from Singapore remotely for an overseas employer, the authorities are prepared to consider that this is not an excising employment in Singapore until the 30th of September, provided that there is no change in the contractual terms of the employment and it is only temporary. So of course, and the guidance states that the 30th September date is subject to review depending on how the situation evolves. And the other situation in Singapore is you have individuals who are unable to leave Singapore due to travel restrictions and they are working remotely from Singapore. For an overseas employer, they will also not likely be considered as exercising employment in Singapore, provided that the extended period of stay is not more than 60 days and the work done during the extended period does not have anything to do with the short-term assignment. So if their stay is extended, but the stay is extended not more than 60 days and the work done during that 60-day period does not relate to the short-term assignment. So if you work that they would have done anyway had they left the country, that should not be considered as being employment income in Singapore. Of course, the 60-day period is rather short when you think about it, since we are all heading up to 2 months already of this lockdown period. The borders are still closed, the travel restrictions are still in place. The Singapore guidelines is silent on whether these 60 days will be extended. So I think we can wait and see if there's any change to that. Similarly, Australia also has similar guidelines to say that if not for this situation, there should not be any change in the tax residency situation of an individual. Now, how about the tax residence of a company? For a company, most of these countries, if you can look at the table below, you would see that the tax residency of most countries within the ASEAN region have determining of tax residency status based on management and control. So typically, when we say management and control, that means where at least one board of directors meeting is held. However, Thailand and Vietnam are slightly different on this. So your tax residency is simply purely based on your place of incorporation. In Vietnam, if you have a company that's established under the laws of Vietnam, then you are considered a tax resident of Vietnam. So could not having your board of directors meeting, for example, change your tax residency in some of these countries? Because in typical situations, you would need to have at least one physical directors meeting to maintain your management and control in the country. So again, we follow the OECD guidelines here who say that that is unlikely to change. Not being able to have your board of directors meeting physically in the country is not likely to change the resident status of a company because of the following circumstances: because of relocation, because of inability to travel, and the temporary change in location of the chief executive and the board of directors. However, in such case, all relevant facts and circumstances should be examined to determine the usual and ordinary place of effective management. What this effectively means is that had this situation not arose, there would not be a change in the management and control of the business. And this situation only arose due to the travel restrictions and the travel ban. So that is why you are unable to have your board of directors meetings physically. So these are called the extenuating circumstances, and they are not permanent, they are temporary. So it should not change the ordinary place of management. So similarly, the directives issued by the Malaysian, Singapore, and Australia tax authorities generally also follow the same message as well. So Malaysia and Singapore has the same guidelines, which say that companies that are not able to convene a board of directors meeting due to the COVID-19 travel restrictions will remain tax resident, provided that the company is tax resident in the previous year, and there are no changes to the economic circumstances of the company, and the directors have to attend the board of directors meeting outside of Malaysia physically or virtually due to travel restrictions. What do we mean here when we say that there are no changes in the economic circumstances of the company? Economic circumstances here typically refers to that the principal business activities of the company, the nature of business, and the business model of the company should remain the same, regardless of whether the board of directors meeting was held physically or whether they were held virtually. So that's what it typically means by no changes to the economic circumstances. In both these situations, so in determining whether your tax residency of an individual or the tax residence of a company, it is important that you have your documentation in place to prove to the authorities in case there are any questions being raised. So for an individual, you would typically need to maintain your travel documents and any guidelines issued by the various governments on travel restrictions to prove to the authorities that because of such circumstances, you were not able to leave, you were not able to travel, to prove that you are not actually tax resident in such a country. Similarly, for a company as well, you will need to document in your board of directors meeting that the board of directors meeting is being held virtually due to these COVID-19 travel restrictions, and it is not a normal course of your business, and these are certainly extenuating circumstances. So moving on to the next issue on cross-border business activities. So we will first look at the scope of taxation in a country. So there are typically two different ways to determine whether the scope of taxation in a country. So that could be either a territorial scope. So in this case, the tax is levied within a jurisdiction, so you're only taxed on income derived within a country. So for example, in Malaysia, we tax on a territorial scope, so only tax on income derived from Malaysia is taxed in Malaysia. Income that is derived from outside Malaysia is not subject to tax in Malaysia. On the other side, we have the worldwide income where you are taxed on your local and foreign sourced income. So if you are deriving income from Malaysia or any other country, then you would be subject to tax on the income where you derive in any country in the world. So in such a cases, there could be certainly situations where there would be double taxation. And of course, if there's a double taxation, would the double tax agreement be able to provide relief? Or if no double taxation, does the domestic provision allow for unilateral credit? And what about permanent establishment? So if you don't have a presence in the country, but you're carrying out some business activities, you could be creating a permanent establishment. And generally, a permanent establishment arises due to different types of business activities, or even if you could just simply have a home office or an office space at a client space, this could create a permanent establishment. So there are generally three buckets to a permanent establishment. So a fixed place of business, which could be a place of management, a branch, an office, a factory, workshop, warehouse, or even a building site, construction site, installation or assembly project. You could also have a supervisory permanent establishment. In such a case where you carry out any supervisory activities that are in connection with a building or work site or a construction or installation or assembly project. The other type of permanent establishment could potentially be an agency place of business. This would typically apply if you habitually conclude contracts or habitually play the principal role of leading the conclusion of the contracts. What this means by principal role leading to the conclusion of the contracts typically means that you do everything for the sale of the contract up to just short of the signing of the contract. So just short of concluding the contract. So you do everything else prior to that stage. So you negotiate the contracts, you meet the clients, you liaise with the clients, you do all of that just short of concluding the contracts. Or if you maintain a stock of goods, or if you regularly fill orders on behalf. So this is general permanent establishment rules. Certain countries may have different peculiarities. Certain DTAs, double tax agreements, may have certain differences in the permanent establishment provisions as well. Some of these PEs are also triggered by crossing a certain time threshold. For example, a construction PE under the Malaysia-Germany DTA is triggered if it exceeds beyond a 9-month period. A supervisory PE, on the other hand, under the Malaysia and Germany DTA would be triggered if it is more than 6 months. So how would these travel restrictions create a PE? If you have people who are stranded and working remotely, they could create a PE in another jurisdiction. Again, the OECD has issued some guidelines here. So let's look at the first one. So if you have a fixed place PE, generally they will mean that there's a certain degree of permanency and it has to be at the disposal of the company. So if you have a home office, this is unlikely to create a PE. So under the OECD guidance, it says that if you are working from home in another country, it's unlikely to create a PE. This is because a fixed place of business must have a certain degree of permanency and it must be at the disposal of the company. In this case, you are working from home because this is due to a government directive, so it's force majeure. Due to extraordinary circumstances, and therefore it's not likely to create a PE. So unless this arrangement now becomes a norm, where after travel restrictions are lifted, you say, look, this works for me, I want to continue working this way. In this case, a PE risk could certainly be triggered and you would need to assess whether a PE would be triggered here. What about an agency PE? An agency PE may be created where you habitually conclude contracts on behalf of the company. The key word to remember here is the word habitual. In such a case, during this time where the travel restrictions, is not likely for the activity to be regarded as habitual if it is for a short period of time because of force majeure or government directives. It is not likely that this situation can be regarded as habitual because it's not permanent, it is temporary. However, this conclusion may be different if the individual was already habitually concluding contracts before the crisis. The other side of that is a construction PE, where there will likely be a higher risk of a PE. So due to the lockdown periods and the travel restrictions, so many construction sites are temporarily interrupted due to the crisis. So the duration of the interruption, according to the OECD guidance, should be included in determining the life of the site. So if this goes beyond the threshold, a PE may be created. So in this case, if, for example, if you have a case where your construction site was supposed to be for a period of 6 months, and let's say we go back to the Malaysia and Germany DTS, so for a period of less than 6 months, but because of the lockdown and the lockdown period of 2 months, so you were not able to continue with the construction work. So therefore, you now have to delay the project and you have to extend the project. So this would be longer than 6 months. So this could very well create a PE for a construction site, if you have a construction site in Malaysia, for example. So how are some of these countries dealing with it? Again, in Malaysia, Singapore, and Australia, there have been their own guidelines issued. And they say more or less the same thing, where an unplanned presence will be considered not to result in the creation of a PE if it meets all of the following conditions. For example, if there is a foreign company does not have a PE in the countries before COVID-19, there have been no changes in the economic circumstances of the company, the unplanned presence of employees is due to travel restrictions, and their physical presence is temporary, and the activities performed during the unplanned presence would not have been performed in the countries if not for the travel restrictions. So the countries that have issued guidance do seem to understand that these are extenuating circumstances that would not have normally happened had these restrictions not been put in place. So having said that, it's important to still note that while the OECD guidance has been issued, it does provide some guidance, but it is just that. It's just guidance. It's not binding on the countries. So whilst countries like Malaysia and Singapore have issued their own guidance, which can be followed for these countries, other countries, it may not be so. So it is unlikely, and it's not clear also if these countries, for example, like Thailand and Vietnam or Indonesia, will adopt their own guidelines similar to what the OECD has come up with, or there will not be any guidance at all, in which case then we will have to go back to the domestic law and the double tax agreements, and whether the double tax agreements can in fact provide any relief from potential issues such as the tax residency and double taxation. So it is important that you look into some of these issues carefully and consider them carefully, because if we don't look into these carefully, these issues could potentially be very costly to your business. So just before we wrap up, just look into what are some of the things you could potentially look into in the short term, the medium term, and the longer term as well. So this crisis is not going to last forever. I mean, we all know that. So things will eventually go back to normal, or what a lot of people are calling the new normal. So what should you do in your business? As a first step now during the crisis, what you should do when you still have people that are stranded, or you still have people that are not able to travel, identify who these people are and keep track of them and where they are, and what could potentially be the tax issues in these countries, whether they could potentially be tax resident. Is it in a fairly friendly tax jurisdiction or not so tax friendly jurisdiction? Would you need to seek clarification from the authorities? Such things should be looked into. So you will need to assess any tax impact and determine any action plan. And next step, as you head out of the crisis mode, what you can do, you can look into your reassess the business travel arrangements. Ensure that you have some internal processes in place for keeping track of employees globally, the duration of their stay for overseas projects. So such tax issues can potentially be managed or mitigated, and also review the mobility planning. Looking into more future, more longer term, so you might want to look into developing some contingency plans and business continuity plans in such a case, and also assess alternative working arrangements so that you could mitigate some of these tax residency issues or permanent establishment issues. It would be highly recommended if you can come up with an internal process or some sort of checklist to map out some of these tax implications. So if there are employee mobility issues, then it could be more efficiently and more robustly managed. So that is my presentation for today, and I'll be happy to take any questions.
Thank you very much, Priya. And in fact, I have one question here referring to tax residency status. I might read it out for everybody to listen, and maybe you could just quickly come back to that. In case of MH2H residents in Malaysia and work income completely sourced from Germany, my work role is for Asia Pacific, and there is currently no legal entity and no direct business in Malaysia. Normally stay in Malaysia less than 180 days and travel, work in different countries in Asia. But this year, stay in Malaysia more than 100 days due to COVID restrictions. Am I exempted from Malaysian income tax due to MM2H special regulations?
Typically for MM2H, it's a bit of a special circumstance, because for MM2H, you are not supposed to be deriving employment income in Malaysia. Therefore, even if you are tax resident in Malaysia because you're staying more than 182 days, your income that you earn from your work that you carry out should not be subject to tax in Malaysia. Because these are I assume these are projects that you do outside of Malaysia, so they are deemed to be derived outside of Malaysia. Does that answer the question?
I hope that answers the question. As far I can not see any more questions coming up, so it seems you answered the question perfectly. If anybody is outside and still having a question that had not been answered during the session, just please feel free to come back to us anytime you wish. Just send me an email and I'll be happy to liaise with Priya or anybody else who might help you. So
yeah.
There are no more questions?
Okay.
No, obviously there are no more questions. Just let me have a quick check. No, probably because you were so concise and so complex in your presentation. Yeah, great. I hope everybody enjoyed the session and you took some helpful insights with you. Thank you very much, Priya, for this most enlightful presentation. And feel free to come back to us anytime you wish. I will liaise with whoever might help you. And hope to see you soon next time. Have a great day. Bye, everybody.
Bye. Thank you.